Recap of Admiral Markets. Today is 4th of November. So today we will take a look at our 4 currency pairs. We will see possible setups. We have interesting setups, euro and cable. Aussie and Japanese yen will be something special. So just after my colleague Mikhail finishes with his little presentation, I will show you possible setups on those currency pairs. So please stay with the presentation. I'm glad that people are coming to our session recaps. That is a good thing. We can all benefit from each other's knowledge, of course, and trading styles. And today I will show you some special things I got pulled onto my charts. First, let's start with euro dollar. So we need to pay attention, especially until Thursday, because Thursday we will have, as you already know, we will have a FOMC meeting. Rate cut will be decided. So far, general consensus is that the rate cut will stay the same, 0.50. But the thing is that many analysts and many financial experts think that the rate cut will be lowered to 0.25. If that happens, we need to be ready for possibly drop, a big drop. But until then, we have to trade, right? At least to try to exploit some movement. So this is what I see on euro dollar. Euro dollar currently. Because I don't look monthly now and weekly. I'm telling this setup is valid for 2 days. So it's done on a 4-hour time frame. If we look at 4 hours, we see that euro dollar is in downtrend. We have supports around 35, 30.40, 75, and 34.40. I need to say that this support is a stop grabber. This was clearly stop grabbing. This was not a valid move. This was not a valid move down there. How can we know that? It's very simple. Open your chart and tell me what do you see here. If you draw the support in there, you will see that 37, well, I would say 75 to 70 is a great support. And it was a great support. You see those numbers, 34.71. Just look at a, try to, okay, I will put this, look at this, lows. 34.71, 34.79. Look at this pin, 34.85, 34.77, 34.72. So what does it say to you? It says that this was a stop grabber. The candle, which hasn't penetrated this low so long, it penetrated it on Monday, early morning prior to Asia. So that means that long positions have been dumped out. And there was institutional selling happening around there. We will switch to 15 minutes time frame, okay? And there was an institutional selling around here as this candle opened around 3 o'clock. So this move has not been valid from technical standpoint. It could have gone to here to test 34.70, but this until 34.50 red level. This was, and of course 34.40, which now presents a support. This was a stop grabber. This was stop grabber. So all of those stops have been collected and subsequently euro has been bought, and we can see that the price went clearly in uptrend all day long, but we couldn't trade it properly. If you remember my analysis, I will show you today's analysis. This was the chart I have posted early morning after my analysis on euro dollar. It was around 10 o'clock. Sorry. So what did I see? This is regular bullish divergence. Okay, MACD Camarilla, which is my proprietary method, and I teach it, of course. On Skype sessions, it clearly said this is regular bullish divergence. But what did it say also? This was stop grabber candle. L3 level was 34.64. I didn't put my levels, red levels here intentionally. I have it in my head and I use it for the analysis, but I have it also in my head, so I don't need to put it to cluster the chart. So this was the divergence. If we draw a nice trend line around there, we could trade a pattern around here. And after that, if you see the MACD was also going down. This EMA is crossed up, so we could trade the divergence when it was crossed up. But also, if we take a look at those ATR levels, I said in my analysis, buy the dips. So euro should be correcting now to 34.50, 70 levels. We had a dip to 34.85, and it was again bought up, but it didn't break this pivot point and H3 line on Camarilla indicator. I said the channel has been broken, but still additional momentum is needed also due to ADR stop projection. The thing is 35, 15, 20 breakout is needed. Did we have the breakout of 35, 20 level? Well, not exactly. That wasn't a very valid breakout. The thing is, it went to 35, 24, but it didn't retest it successfully. Now it's too late, if you ask me. But those who are having long positions over there, they are free to leave their positions. At least they can put their stops to break even. The thing is, if this pattern came to there and then subsequently pushed the price up above 35, 24, 25, that would be a so-called breakout pullback continuation pattern. But still we didn't make that continuation. So the breakout was at least good for 10 pips if you count 35.15. But we couldn't position ourselves because of unsuccessful breakout pullback continuation. So we need to break this high to further continue up. And today is Monday, and there are no big momentum driven news, so we cannot count on it. Maybe it will happen later or during the night. Yeah. And this fake pin bar, as Jag said, fake pin bar, Yugoslav, yeah. Fake pin bar is indeed stop grabbing pattern. This is all fake. And if you remember my system from which I present you, trading fake outs, basically it was hard to trade it because it didn't happen in London session. But these kind of setups can happen frequently, so that is a matter of time when we will catch that fake breakout, and where we can exploit it. Today it was nice. If you have the strategy I sent you, this was a nice fake breakout to the upside, and you could trade this fake out. The stop was 10 pips, and the target was around 15, 20 pips, so it couldn't be caught. Really, we had some nice fakes of the pivot points. But for setups, I would suggest buy towards 34.85, 34.70 with stops around 34.30 target and 35.90. This is possible until Thursday, but try to enter a long if you go for a long as low as possible. As low as possible, because if they dumped the price over there, it's not 100% that the price will continue to form zigzag to 35.90 level. The thing is, what may happen is in early Asia, they may spike up the price or they may possibly drive the price lower, okay? But if you see those two candles, they both closed above 34.50. So anywhere down there could be a nice, valid, technically valid sell with stops just 10 points below this low, 34.30. And try to aim as high as possible, at least to 35.90, okay? And if that doesn't happen, alternatively, we can sell around 35.70 for scalp trade. If that doesn't happen, why am I saying that? Look at 38.2 retracement. Okay, now I will technically describe why I charted my Fibo like this. If you see this stop 100%, what does it mean? It means that I have included a retracement trade, FOMC candle top, without any substantial retracement until this fake pin bar. So it was basically a retracement, so from the left to the right, and we are going into counter trade. If you buy it around, if you bought it around there, and we wait for another second chance opportunity to dip again and buy subsequently, we are going with a counter trend trade. And the first thing it can happen, it can be bought down there, it can be, and it will test the confluence zone around 35.70, 35.85. This is confluence zone, okay? But if it doesn't happen, if it doesn't fall to buy, then it might just continue to go up. And I will sell it over there, keeping my stops on 20 pips, 15, 20 pips, and try to go for a blind scalp trade. This is called magnetic trading. This is naked scalping without any indicators. Naked scalping. Around here sell, blind sell, if it doesn't have very, very strong momentum. So we don't want the price to go like this, shoot up like that. We want the price to drive it slowly. What I mean by the price, slow market price, is very, very simple. Let me show you the chart. The slow grind of the price is, we can see it here. This is the slow grind. Look how the price is going zigzag. Now this is big momentum, okay? But this is slow grind. Slow. You see how the price respects this trend line and goes slowly, slowly, slowly. So that is a slow grind to the upside. So we want the slow grind there and then sell. We don't want a momentum push because it may shoot it up to 36.15, where 50-point retracement stands 36.12, 10 to 15, okay? And that will be surely a stop loss hit, okay? So we want to see the price. That is why I don't like to use pending orders, because I don't know how big momentum will be, okay? What if momentum is too strong and it drives the price there, and I got it right, okay, we can sell it there. But after it hits stop loss, it goes down. So that is why I don't like those pending orders when I do counter trend trades, especially when I do possible scalp trades. So around this level we could have a scalp. But again, we need to see whether the euro will come up for some substantial pullback, or we may see it down there. So far, I would count on buy the dips, as it looks so far. The next thing is GBP USD. GBP USD, very strange movement of that currency pair. It's very supported by fundamentals. So if you see the fundamentals for GBP today also, this is a strong news release. If you read the description of construction PBI, it says it's a leading indicator of economic health. And that is true. I have learned that in my economic study when I studied economy. And really, indeed, construction PMI is very strong indicator. But the thing is, Cable X very strangely last couple of weeks. Basically, all of those news, it seems like they have been counted in. But yet again, I'm counting, tomorrow we will have services PMI. I'm counting on better numbers. And if that is the case, the scenario will be, this is the possible scenario. Buy towards 59, 50, 59, 30 with stops around 58, 80. That means that we need to have a lower leverage because our stop is big. And the target should be 60-20. The target should be again to the upside. But this is why we have wide stop to protect ourselves. We need to use lower leverage. You cannot risk 20% or 10% in this single trade. Risk 2 or 3% if you want. But it's crucial to have a dip. Now I'm not sure whether, looks like the price is now 59.44. But to me, it looks like a bullish setup because we have a rounded bottom over there. This is, let me see, rounded bottom. Yeah, this is cable. This is a rounded bottom, okay? Rounded bottom. This is pin, stop candle, dragonfly doji, okay? Or stop candle. I like to call it stop candle. When stop candle happens around big supports and resistance, that means that the price will usually continue to go up. This is also part of teaching naked trading. So this candle, for me, it's important, but it has already happened. Around here, if you see the price, it was bought out after the stop candle. The price went to the upside. And still, we have that level, 59.50. It was a breakout. You see the breakout. This is retest. But here again, they are driving the price lower. This could have been continuation if the price just went up this or this candle. We should have continued to our next red level, which points exactly at 60.23, okay? So it might happen that the price will go down and then it will be subsequently bought up again, like in this example. Next very support will be here at this candle, because this candle was a big bully candle. So we are standing now at support. But yet again, it's too late now to make an entry. But for positional trades, stop should be around this level, 58.80. And we should try to get this cable to the upside. Because you see the direction also. If you watch the history, you see how the last jump off of this level, 58.90. Okay, 58.90 to 59.10. Today low was 59.10. You see the historical price action. It was propelled some 200 pips to the upside, okay? So also that is why I'm trying to see the bigger picture. This is the rounded bottom. And the price shouldn't get anywhere there. But if it happens, well, that means that the price may well again continue to go down. But so far from this, this should go up, but we will see. That is why I said buy towards 59.50, 59.30 with stops around. So anywhere to the downside. But these are levels that have a confluence around there, historically speaking. So they may go to 59.35, I know, and then continue to go up. But it will also go around 59.10 and go up. So we cannot sell it now. If we go for positional trade, it's too high, it's too low to sell it now for positional trading. I don't think now about scalping. So dip towards 59.50, 59.30, and then try to drive it to the upside, placing stops around there. Alternatively, sell around 60.20 with 20 pip stop if you don't get into a trade. Again, a magnetic level. You see 1, 2 reactions, 3 reactions, how price react to 60.23 scalp trade. I wouldn't go positional here, only a scalp trade. Scalp, little scalp mode. Now, next currency pair, Aussie, stay out. I don't trade Aussie at the moment. First, all fundamentals supported, but we went down contrary to fundamentals. Technicals also failed on Aussie. After this, it went, after our last analysis, it went some 15 points to the upside. But that wasn't what I was counting on, 15 points. That is neglectable for positional trading, okay? The price fell down, but what happened is it formed a megaphone pattern. I just don't trade this pattern. And I don't like this pattern. This is very nasty pattern. You see widening top or widening bottom pattern or infamous megaphone. I don't like that pattern. Why? Because you see, first Aussie is in downtrend on 4 hour, well, daily is bullish. Look at daily candle. Yesterday we had good news for basically Australian dollar. And after a drop to this level, price of course retraced. But this is a megaphone. I just don't want to trade it. It can go too low, then it can go too high. And especially why I'm saying that, because on Tuesday, 4:30 our time, we will have a cash rate and RBA rate statement. RBA statement. I would stay out. And I just cannot see the setups on Aussie at the moment, so that is my suggestion to stay out. Sometimes staying out is equal to having a professionally managed position. And that is absolutely true. Sometimes staying out of trade is equal to having a profitable trade. These are support, these are resistance levels. But I don't count on it now. We need to see a RBI cash rate statement. I just don't know what will happen, especially because of this megaphone. Why would I trade something which I'm not sure what will happen subsequently? We have other pairs. Euro Japanese yen, classic consolidation, classic accumulation. Classic accumulation phase from market cycles. Accumulation is spotted in triangle forms. This is, you see the price spike up, high, and high low, then zigzag to the vortex of the triangle. This is called accumulation phase. Why accumulation? On yen pair. Because government, the chief governor of Bank of Japan will speak 6:30 early morning, probably giving some cues about state of Japanese economy. Now the price is consolidating here. Only two setups which I see valid are breakout pullback continuation pattern in any direction, bullish bias above 133.35 retest. You see we have a confluence here. Red level, you see the reactions of those red level, and this red level I have it on my chart for quite a time. As I told you, these red levels are historical levels of price action. And that is why price reacts good, nicely to them, because they are historical in their nature. If this happens on this triangle, I will show you. If this is the triangle, and we have also nice level of resistance out there. I didn't draw it very well. So this is a resistance level, this is a triangle, and the price is making zigzag inside of it, drawing close to vortex. What would you do? I would open 15-minute chart and watch the price action up outside the triangle to the upside. If it happens to shoot up above this intersection point or above here, I would wait for breakout, pullback, continuation, buying it after this point. Okay? Again, breakout, this is the entry point. If the price retests and go 2 pips above it. Breakout, pullback, continuation. It may happen that the price is going to the downside, but to the downside, you see, the price is going to the upside. So that is why it's hard to trade it on breakout to the downside. Because to the downside, I would like to see this level invalidated. 132.61, breakout, pullback, continuation. Just these trend lines of the triangle are not that good without any level besides. And I don't see, this is empty space for me. 133.35 to 132.61. This is empty space for me. But just look the price. Where did it, okay, now from technical standpoint, I ask you all, where this price has stopped? It has stopped on the red level, okay? Look at this, look at this, look at this. The red level. Where the price stopped at the red level, 33.35. Both levels, one to the downside, second to the upside. I don't have any price in between. So that is, I would like to see a breakout to the upside. Buying the second validation point, breakout. So breakout, pullback, continuation. Breaking the breakout point is our trade. I don't see alternative scenarios for Euro-Japanese yen due to Bank of Japan Governor Kuroda. I just don't, wouldn't like to trade this consolidation. But of course, if valid setups form in later, why wouldn't you trade breakout, pullback, continuation? It would be good. It's impossible to have all of those historical prices because the thing is, the only thing I do with those historical prices, I use it myself, and it's proprietary method. I have invested many hours in drawing for each currency pair. So the thing is, I can only give you on session recaps, and I give only to my personal students where I do mentoring. So this is very, very, that would be very unfair to the people who paid actually for it now to give all of it for free, but you will have it for free in all those sessions I do with you. That is the only thing. I have invested really a lot of time drawing there and consulting. I didn't do it just myself. I had two friends, traders, along with me, drawing, making consensus on those levels. So, you know, I also share from time to time some profits with them, so it wouldn't be very, very fair to them also. And of course to the people who actually paid. But of course on those annual market sessions, I will just show you for free, of course, free of charge. So basically try to copy those levels currently we can see, and you will see the reactions. You will see the reactions also on your charts. And the thing is, you see this bearish wedge. What happened is the price went upside, up the wedge, and then it was subsequently broken, creating again a false breakout to the downside. But this is 4-hour time frame, so for 4-hour traders, stop of some 60 pips is not much. So this is why I'm telling you, try multiple time frame analysis. 4 hours traded on 15-minute time frame. So if the price goes up, test this level and break the breakout point, you can trade it. Breakout, pullback, continuation trade. So let me again make a recap of what we did today. Euro dollar, downtrend but accumulation on 4-hour time frame, and due to possibly rangy price action, we want to buy into dips and sell into rallies, okay? This pin is fake, this level is real. These candles just show intraday strength of euro dollar. But the price on 4 hours needs to close above 35.15. This is now nothing. This is nothing. This is small zigzag, but it isn't a sign of a nice momentum to the upside. That is why I'm saying this scenario, although if you went by my analysis early morning, you could have, there was a dip subsequently towards 34.85. I think the dip was 34.90 or something like that. I didn't trade it. I traded that breakout, but I closed it for meager 5-6 pips because I saw that the price didn't have momentum to go upward, and it was too late for me to expect that the price will go to 35.90 at the London close. That was pure logic. That is why I closed my trade in 5 pips only. So now some traders would say, how come that I use my stops, let's say I made it 20 pip stop loss and I just got only 5 pips. I would be sincere with you. Let's say that you trade 15-minute time frame. Okay, this is just for showing purposes. This isn't actual trade. What happened is, let's say that we trade this breakout there, and we have the price is breaking out to the upside. We go with the trigger happy trade. Okay, open a long position, and what happened is the price goes 10 pips and then drops 15 pips below our entry. How now? Am I crazy? If I see that if I go with counter trend trade, and this is counter trend trade, if the price is rejected of that level and then it goes 15 points below my entry point, of course I would close it at least on break even if it comes up again. It didn't hit my stop loss. It went 5 pips in profit and 10 pips in profit, and then again start to fall down. And I see that those reactions were very, very solid, because you see the price, it was rejected 3-4 times of this level. Then this dip was bought up, it was 34.90, and then the breakout was around there, 34.15, and the price went only 10 points. And I can see that the price went 10 points, and then again it was starting to get to my entry point. Of course, I would close my trade for 5 points. I'm completely right. I cannot hold it if I don't position myself, and I cannot position myself here. I need to position myself there, because stops are wider on 4-hour time frame. On 15-minute time frame, I can go for breakouts, but first it's a counter trend trade. Second, it's a close of London. The third thing is we don't have momentum for the breakout. And sometimes you just need to accept the fact that we trade for lower risk to reward ratio, especially if you go for breakout without any momentum. Now I just now what I see now, I would like the price. I would like to see the price going up, because this is where real buyers today were. This is not, this is fake. And from technical standpoint, the guys who are already in a trade, this is perfect. I was out of my trading station when this happened. When I said in my analysis, go for with my Camarilla MACD, correcting now to 34, 50, 70 level. So retrace to the downside in eating, setting stops below the divergence, and for breakout trades, momentum is needed. So this is why I don't like it. You see, it would be nice to see Euro test 34.80.75, but it doesn't matter. Some traders just trade those dips. How they trade it? I will show you how some traders trade those dips. Let's say that they want to see this pair, euro, dollar, around here to buy it. They would buy, let's say that this account is 10K. Now, the proper money management for positional trading. If we want to buy the dips, we want to see price going down, and we want to see clear level of support. So, on 10K account, 105 to 1K to one standard lot is good if you use 35 pip stop. Let's say maximum 35 pip stop. So let's say that we want to open a standard lot. If we don't go for breakout trade, we will not open a standard lot here. Only at the breakout we can open a standard lot. But for positional trading, 0.20, 0.20, 0.20, 0.20. That is how proper money management is done on retracements. Buying the dips or selling into strength, it doesn't matter. Proper money management for positional trade is buy 0.20, buy 0.20, buy 0.20, finally buy 0.20. Placing your stops below, I would say, for positional trading, below this real support. It doesn't matter, this can happen always, because smart money knows where stops are, and this is fake, but this was smart money, and this was also smart money. Buying after stop grabbing. Okay, so you won't exploit full lot at the break of 35.15 without prior retest. So you go spread. You need to spread the price out, 0.2, 0.2, and find times like that to support. That is how you can trade one standard lot with positional trading. Cable, again, rounded bottom, buy towards it with stops around 58.80, targeting 60.20. If you go with 10K account, how much would I risk here? If my stop is presumably, let's say I have bought 59.50, let's say hypothetically, okay, and my stop is 70 pips, I would go with 0.20 on 10K account. So around there I would go with 0.20 targeting, sorry, here, 0.20 here, stop loss over there, and targets around 60.20. And I would go with 0.20 lot size, because we are risking 2% on that particular trade. And it's trade on 4-hour time frame, so we need to be patient for that, okay? 4-hour trades needs patience. Support levels, resistance levels. And yet again, Aussie, stay out of Aussie. Aussie is a megaphone pattern. I will look at this. Going down, making lows, making tops, making lows, making tops. Probably it may go to the upside, but we will see what reaction to cash rate will be after conference. And yet again, Euro-Japanese yen aiming for this, if it happens. If it doesn't happen, well, we miss the trade, but we save our money for potential bad trades. Now, guys, if you have any questions, you can ask me. Of course, pay attention to Thursday. Thursday will be most important day concerning euro-dollar pair, and especially euro crosses. Because euro-dollar, we have a bid rate announcement. I will show you again on Forex Factory. This is what they are aiming for, 0.50. But the rumors are that the price, that the actual bid rate will be 0.25. And look at those red numbers. Sorry. Look at those red news all day long. I think I will miss Thursday. I think I will trade on Friday, at least light trades. Oh, again, non-farm employment. These 2 days will be very volatile. Very volatile. Yeah, Super Mario will talk. This is, if he gets dovish in his speech, we can see a very big drop to the downside. And that drop, if it happens, will target 33.50. And this may be a sign for us to sell into rallies. But yet again, wait. We need to wait. We need to be patient. Thursday will be that day. And let's finally see again Euro-Yen accumulation triangle. What is accumulation phase? First phase of market cycles by traditional market cycle analysis. I will show you here. This is accumulation. The price is going nowhere. It rests inside the triangle. That is, in Forex market, there is accumulation. After accumulation, we have distribution, and that distribution will go markup, markdown. 4 market cycles. 4 phases of market cycles. So every price needs to be in a sort of equilibrium before it makes a trend. And it looks like so far today this is an equilibrium phase for Euro Japanese yen. You see how the price respects red levels and vortex of the triangle. It doesn't go anywhere. It just rests inside, waiting for that announcement. Equilibrium. Okay? If Mario, okay, but really, okay, now I'm getting comments. Expect this. I think Mario will rise euro dollar. Expect this month up to end of the year 0.40. Guys, I agree with you, but I cannot trade, and we traders cannot trade on expectations. We need to try to find some cues. That is why we use technical analysis, fundamental analysis, technical indicators, red levels, Camarilla, so on. Systems. I don't like systems. I like to call it methods of trading methods. Not just saying it's a system, it's a trading methodology, okay? Trading methodology. So that is why we need to find logical reasons behind our trades. And yeah, it may go weekly chart, I don't know, we can go up, well, let's open euro dollar. But we cannot trade it, I don't know, maybe the price will go to 400 by the end of the year. But that would mean I would need to trade monthly or weekly chart. Look at this candle on weekly. It has eaten completely 1, 2, 3, 4, 5 weeks of trading. So let's say that traders who trade weekly charts have open positions around there, wanting the price to go to see 39.85 or eventually 40.40. Now after 300 pips profit, now they are maybe in a loss, okay? For those who trade weekly charts. They may be in a loss now after 300 pips of profit. So that is why I don't, yeah, I'm scalper basically. I'm not pure scalper. I can trade swing scalps intraday, but basically I am intraday trader. And we can see it. Yeah, why not? After some potentially big news or big dollar weakness, we can and don't forget the prices are driven by dollar index. They are not driven by euro or cable or Aussie. Dollar crosses are mostly driven by USD news and USD index. Okay, don't forget that. So that is why I'm counting on potentially now on dollar strength, because there are some signs that tapering may finish in a March so far that can give the strength to dollar. But those are all fundamental aspects. Let's stick to intraday in technical aspects. For intraday, 4 hour, 1 hour, 15, 5. Those are time frames. And we will see what will happen on Thursday. If that happens, that the bid rate is dropped to 0.25, then try to enter a short. That will be we will have webinar on Thursday, so I will probably mention it again. Then we need to sell after some rally, but we will see what will happen. For me now on euro, it looks like it needs to go up, and I said it on Friday, but we saw that price was hanging around there, and subsequently they clear the stops below and drive the price forward. I know that many traders lost money, and that is the thing why I don't want to hold my trades overnight. Of course, it always happens to that you want to trade the position trades. But if you have, let's say that this account is yours, 10K account. It's not normal for you to trade 0.2 on counting on 50 pips. There is only $100 of profit. So there is there are two main things in trading. Now remember what I say to you. Two main things in trading. If you trade institutional accounts, that means that you add one more zero after this. So it's around 100K account at least. Then you can trade, you can just trade for a living, okay? You can just trade for a living if you have 100K at least. And in some countries that is not enough, okay? But let's say average, if you have 100K account, you can try to trade for a living, because that is called institutional account. If you have account, let's say of 10K, that is small account, because we need to upgrade the account. We are building the account. So it's very hard to live only if you have 10K. So you need to build your account. And 10K account is a base for a building account. Anywhere from 100K and to the up, in some countries, it's okay to have 50K account. But in most countries, it won't be enough. So I just know that some guys earn a lot of money in their jobs. So let's say that you are a pilot of a civilian airplane. The average payment of a civilian airplane pilot in well-developed European countries is 90,000 euros per month. Okay, I said it correctly, 90,000 euros per month. That is the average payment for pilots who pilot civilian airplanes. No 90K, exactly, 90K euros. So now imagine, no, I need to write it down so you can say it's 90K. 90, not 19, 90K. So let's say that a pilot earns 90K each month, guaranteed. My colleague, who is a doctor, that is not my colleague, he is my friend, and he is a doctor. He lives in Serbia, and in 3 months he will go to Norway. The initial payment of my friend will be 15K for a doctor. And he's not a surgeon, you know, he's surgeon. He is a radiology doctor. So he's not, he doesn't save lives. He is a good doctor, but he doesn't save lives, yeah. 15K. And now imagine how those two guys would trade. Would those guys even bother with 10K? I would say that they wouldn't even bother with this. They wouldn't bother with trading even for $100,000. And that is always my suggestion to you guys. If you know how to make money of the $100 and you have money, spare money, or you want to be a full-time trader, if you can make $200 of your $100, then you need to invest at least 10K up to 50K and try to build up your account. I know that many traders try to make a living. I'm always hearing them traders saying, okay, Tarantula, now you will help me, I have $100, now let's help me to build $1,000. I have never done that. I have never built 100 from 1,000. For me, building goes slowly. And let's say that, hypothetically speaking, you have 10K. And if you lose the 10K, you don't have anything. Okay? And then that means that you cannot trade it anymore, right? Because you have only 10K, and if you lose it, you don't have money to trade. So that is why you need to learn money management. And yes, you listen, money compounding is the formula. If you want to, okay, now listen to me. I have made a digression, but I need to say you this. First thing is, you have building accounts. Building accounts. That is the accounts up to 10K to 50K, which you use to build institutional account. When you build your account, you will have institutional account. Or if you are institutional trader, you will have 10 based accounts, 10 basic accounts, let's say 10K, merged together. So they will form one institutional account. I have worked with the institutional accounts. Now I'm passing you my experience. And the third thing is part-time account. That means that you have your day job earning 90K as a pilot, but you like trading. You're in love with trading business. And let's say that your part-time account is 25K. So you want to earn money on that part-time account and withdraw the money. So let's say that you have made 10% in a month and you have earned $2,500. You will withdraw the money because that is your part-time account. You have your day job, you have part-time account, and you just withdraw, you're withdrawing the money each time you earn the money. If you have part-time account, that is automatically, if you have part-time account, you don't build your account to be institutional account because you withdraw the money. So guys, you need to decide. You need to decide for yourselves whether you want to be full-time traders trading on your account and on institutional account, or whether you want to be a part-time trader keeping your day job. The advantages and advantages are both. When you're doing a day job, you have, I presume, that you will have your wager each month or each week guaranteed, right? So you can count on your, I presume that most of you have good wages in your countries, so I presume that it is anywhere in between $1,000 and $5,000 probably in your country. So we will have that money guaranteed, and you are just happy to trade for, I don't know, for a better computer or maybe for a better car if you sell your car and buy a new car. But for those people who want to trade full-time, they need to have institutional accounts, or they need to build up their accounts to be institutional traders, full-time traders. And that is the only truth. And I will repeat you again, if you can make $200 out of $100, the same formula will apply to make 10K, 20K out of 10K. You just will do with more money. But lot size, money management, and risk management will be the same. Lot size will be different, but money management and risk management will be the same. And these are the only truths you will ever learn in Forex business. Don't fall for that mischievous advertisements to buy 20K systems. I know that there is a system which is selling for $20K. You can Google for it. I will not say its name. I know the name. I was on their presentation. I did that intentionally just to see what they are trying to sell. Guys, for 20K, you will get PDF and custom-made indicators. Custom indicators. And those indicators are more or less the same, which we all have on our platform, just slightly modified to suit the sellers. And now, when some people doesn't want to invest $1,000 in full education, I can say that that is not normal, guys. So when you start to trade, you need to have a knowledge. If you don't have a Google knowledge, that means that you are a self-taught trader. You need to invest. You need to learn how to trade. So spare out anywhere from $1,000 to $2,000 on proper education. And then the rest of your money invest. But never fall for that 10K, 20K PDFs. You need to learn from a good trader, and you need to learn it live. He needs to teach you. He needs to give you his templates, his words, his trading methods to pass the knowledge to you. Trading systems which you can buy over the internet, I call it PDF trading, because you don't know anything about that system and you trade it basically just what PDF says. And even you will never hear the voice of those traders. So now I have made a digression from our session recap, but I just wanted to respond to many traders which have been asking me how, what, when, how much money should I invest. Now when I see that you have come in nice numbers on this webinar, I hope that I have answered one of your most asked questions. How much should I invest? How much should I trade? When should I trade? What to do? So you need to make a decision, and then you need to invest. Every job you will work needs to be invested in. If you open a factory, you need to invest in people, in knowledge, and in machines, right? But investing in yourself is, for me, and I think that I know a lot about investing, investing in yourself is the best thing you will ever do for you and your family, because you're just, there is a common how can I say, word or common sentence in our language. The more you know, the more you're worth. So basically, investing in yourself is never a miss. Even if you don't trade the money, if you don't make the money in the beginning, eventually you will start. And there will be losing months. But the thing is, you will be safe, your account will be safe. So that is why it is important to just to pick what trader you would like to be. Part-time, full-time, or eventually institutional trader. And institutional traders are always full-time traders. So guys, that is all from me today. I show you every session, each of those pairs, our session recaps for all of those 4 pairs. Maybe in some later session I will include other pairs, but for now we have 4 pairs. Try to exploit parents, try to exploit the analysis. Watch me and Chris and our mutual webinars together. We will do it together, of course. There will be a lot of webinars me and Chris do together. we basically have more or less similar methods, so you can always try to learn from us. And of course, I always would like to help you, and if you have any questions, you can always ask me. Thank you very much, guys, for attending. Thank you, Yugoslav. Thank you. Well, I have answered mails also. Thank you. Arnaretnik asked me, you told institutional traders, please describe in once more. Again, I will do it very fast, because we have exceeded the time for this presentation. 10K to 50K accounts are building accounts. Okay, I cannot right now. We need to be fast. If you have 10 accounts of 10K, then you have merged one account of 100K, and you can try to be a first-time institutional trader. Institutional money is big money. They usually trade with big money. That means up to above 100K. That means from 100K to possibly a couple of millions or 10 of millions. So that is institutional trading. Accounts which are below 100K you cannot live just by trading solely those accounts. So you need to build up your accounts. So first you need to be building trader, then you can trade institutionally, and eventually you can be only a part-time trader, trading only your account but with your day job. That is institutional trading. And institutional money is money which is usually bigger than 100K dollars. Because usually what they invest, they can invest their spare money, or they will join their money into one single account, and that is called institutional account, and those are institutional traders. So guys, again, thank you for listening to me. Thank you for being with me. I will see you very, very soon. Thank you very much for attending webinar, and have many green pips. Goodbye.
The